This is a BC Eagle Finance video. Brigham and Houston Chapter 2, Section 3, Financial Markets. What is a financial market? A market is a venue where goods and services are exchanged. Very simply, if you've gone to a farmer's auction where you see cattle or other farm animals come across the block and there's an audience that's bidding on the animals and there's an auctioneer that's regulating the bids, you have an idea of what a market is. The only difference between the farmer's market and Wall Street is the location and the commodity being sold. A financial market is a specialized type of market where individuals or organizations wanting to borrow funds are brought together with those having a surplus of funds. And so a financial market associates those that have excess cash and want a return on that cash with individuals that want to use that cash to buy stuff and are willing to pay a return for that privilege. Here's a picture of two different ways that financial markets can transfer money from those that have extra savings to those that want to use it. The first is direct finance. The second is an indirect finance. Let's look at both. Under direct finance, you will have the lenders, those that have excess cash themselves, that would consist of households, firms, governments, and non-residents like foreign foreign companies or foreign countries. They put that money into the capital markets, and through individuals like investment bankers, that fund is transferred to other firms, other governments, households, and even other foreign countries and businesses with the cash that they have available. In other cases, the lenders that have excess cash, households, firms, and governments, will go to financial intermediaries. These would be the credit institutions like banks and savings and loans and mutual thrift corporations, and some other monetary financial institutions like pension funds or mutual funds, and insurance companies that will take that money and in turn invest it, and when they invest, they give it to the folks that want the money, other firms, governments, households, and non-residents. Essentially, the difference between direct finance and indirect finance intermediaries is that the direct finance intermediary does not have a middleman or a broker that channels the funds from those that have excess funds to those that want to use it. With the indirect finance, there would be the group of net savers that would use these institutions to transfer the money on their behalf. Now, what are different types of financial markets? Well, first, let's make the distinction between physical assets and financial assets. Physical assets would be plant, property, and equipment. Those assets that are tangible, you can see them, you can count them, you can see that they are physical in nature. Financial assets really represent business rights. They exist because the legal system says this promise represents a right that can be enforced. Also, there would be spot and futures markets. A spot market is usually what we think of when we think of a market. That's where buying and selling happens on the spot, right where the auctioneer and the buyers and sellers are. That is usually in the physical location. A futures market is a market where people today will agree to buy or exchange currency at a future date at a set price. Hence the name futures contract. There is also the distinction between a money market and a capital market. A money market is usually short-term money, less than 90 days, and a capital market is long-term money used to buy long-term assets. In the United States, a capital market is defined as any money that is longer than 270 days. There's also the primary versus the secondary market. The primary market is the initial public offering. This is the first time either bonds or stocks hit the street or are bought by investors. During the primary market is the only time that the corporation that issues the paper for bonds or stock receives any funds at all. In the secondary market, the trades exist between individual investors. In the secondary market, not a dime goes to the initial corporation that originally raised funds in the capital market. The secondary market just represents exchanges between individual investors. And then there is the public versus the private market. The public market is usually what we see on TV or other news sources about traders buying and selling. That same type of action can happen outside of Wall Street in the private area where the transactions are not monitored and promoted and reported on in the financial press. Now, how does this capital formation process relate to the corporate balance sheets that we learned about in Accounting 1 and 2? Here's a picture of a balance sheet. And to review the balance sheet, the left-hand side of the balance sheet represents the resources that a corporation has and uses to earn its income. They are known as assets. The entire right-hand side of the balance sheet represents those financing sources that the corporation uses to finance principally its long-term assets. Now, a balance sheet will have current assets, those assets that will quickly be turned into cash during the operating cycle, and the balance sheet will show current liabilities, those obligations that will demand the use of cash within the operating cycle, usually 1 year. When we talk about the capital markets, we're not really talking about current assets and current liabilities. What we are talking about are long-term uses of cash, buying long-term assets like investments, plant, property, and equipment, and intangible business rights like patents and trademarks. And those assets are financed through loans or debt capital, through the issuance of stock, which is known as contributed capital, or through the company's own undistributed income known as retained earnings, which goes by the name of earned capital. So capital that is raised will appear on the right-hand side of the balance sheet in the form of either loans, borrowing, stock, owner contributions, or retained earnings, income that the business has earned but has not paid out to owners as dividends. These sources of funds are used to buy long-term assets. Capital markets also have a classification, or let's call them financial markets. They can either be classified according to their maturity into money markets, short-term sources of money, or capital markets, long-term sources of money, long-term sources being over 270 days. They can also be classified as to their trading structure, which is shown as the primary markets, the IPO. This is where the corporation actually gets access to the cash it needs, or the secondary market, where the corporation doesn't get any cash, but the cash is just exchanged between the individual investors. This next slide indicates who the major players are in any of the financial intermediation transactions that we have. So let's look at a primary market or an IPO. Here you have a corporation that needs cash. It wants to buy stuff and it needs cash to get it. So the corporation will get some professionals who advise it on when to offer, at what price to offer, the amount that the corporation can raise, and so forth. Then the corporation with its advisors will go to another professional called an underwriter that actually takes responsibility for pushing that paper into the hands of investors. The underwriter also gets other sub-underwriters known as the certificate or as the syndicate to help push the paper into the hands of shareholders. The underwriter works in conjunction with the stock exchange, like the NASDAQ, the National Association of Security Dealers Quotes, or the New York Stock Exchange, through a fourth set of professionals called brokers, and they will align the buyers and the sellers. And then individuals, institutions, and even foreign countries can buy and sell those shares in the primary market. In a secondary market, you have the same individuals, institutions, and the rest of the world that will go through brokers who work at a stock exchange, except the trades now are between other individuals, institutions, and foreign entities that want to buy those transactions. So institutions and entities that want to sell, that are linked through the financial markets to those institutions, individuals, and foreigners that want to buy. What function do the financial markets have in a well-developed society? They facilitate the flow of capital from investors, those that want to buy stuff, to the users of capital, those that want to invest. A well-functioning financial market provides savers with returns on their money, future income, and it also allows entities that want to buy stuff to have the cash that it needs to actually get that stuff. The thing to remember about a well-functioning economy, the amount of money that's available for investment in stuff is limited by the amount of money that savers are willing to save. A well-functioning financial market also promotes economic growth because those countries that have well-developed financial markets, in addition to a strong rule of law, just tend to do better than other countries that do not have a good financial market or have strong laws. Let's just take a look at what the world would look like from a financial market point of view. This is a map of the world, and the countries like the United States, these guys up here, and these guys down here have per capita incomes of $50,000 or more. The dark green, like Canada and Australia and France and Germany and England, have per capita incomes between $35,000 and $50,000. You can see as the green gets lighter, the per capita income gets less. Now, we all recognize some of these countries. This is Norway. And can you guess what this country is? Let's take a closer look. That's Saudi Arabia, financed mostly through oil. And across the top of the African chain, you have Algeria, Libya, and Egypt that just don't do quite as well. Looking at the 2015 statistics from the World Bank for GDP, you can see that Norway, Singapore beat the U.S. as far as per capita income. And then the rest of the world, the European Union countries, Japan, and the underdeveloped countries, you can see, have a very diverse amount of GDP per capita. Now, in addition to financial markets that's buy and sell products, there are also other derivatives that come from these products that can also be bought and sold. These are known as hedges. A hedge is a security whose value comes from or is derived from the price of another security. In other words, you have a stock or you have a commodity like farm animals or steel or other precious metals that can be bought in the spot market, or there can be contracts to write their purchase forward. You can agree today to buy certain commodities 3 months from now. That's known as a private forward contract. That same contract that goes through an auction like the Chicago Board of Options Exchange or the futures, that would be a futures contract. You must buy the contract at the rate that you agree in the future. It's enforceable just like buying something in the spot market. There's an options market. Again, Chicago Board of Options Exchange would be an example of that. You have the right, but not the requirement, to buy at a certain price in the future. And then there are other agreements, mostly associated with debt instruments, called swaps, where an entity that is obligated to pay a fixed level of interest can swap that instrument in exchange for another debt obligation that has a variable interest requirement that would go up or down with the general level of interest rates. Of course, if you're doing a swap and you have a fixed interest rate, your hope is that interest rates in the future will go down so that your variable rate will be less. So, when hedges are used, they can be used two ways. Number one, they can be used with other commodities. Like if you're Boyer Candy and you want to buy sugar, well, having a hedge or a futures contract to buy that sugar in the future reduces your risk. You lock in the price and don't have to worry about the price going up after you sign this contract to buy stuff 3 months from now. That's called a covered transaction because the derivative is combined with buying real stuff. And an example of that would be an importer or Boyer's Candy that wants to lock in the dollar value of that commodity today for the purchase that will happen sometime in the future. There are other transactions that can come in that are usually done by speculators, and this is called trading naked derivatives, meaning that there is no underlying commodity that they're going to buy or sell. They just want to trade on the spread of the value of the particular derivative. They don't want the stuff, they just want the increase in price of the derivative by itself. If the speculators guess correctly, there is a lot of money in trading derivatives. However, these instruments are very volatile and speculators don't always guess correctly. And in those cases, they lose a whole lot. So the speculators should be fairly sophisticated, and this is not the place to start your investing career. Here's a picture of the different types of derivatives that you guys can run into. The whole class of derivatives can be broken into a forward contract, which is a private contract between a buyer and a seller to either buy or sell a commodity in the future. A futures contract is a contract that goes through an exchange where there is a broker that aligns the buyers and the sellers. A futures contract requires the contract to go forward. In other words, there must be a buy and sell of the underlying commodity. An options contract, which also has a public element to it, uh, gives the holder of the option the right but not the requirement to buy or sell in the future. And then we have swaps for either debt swaps or currency swaps. Under the classification for options, there are two types of options. A call option, you would buy a call option if you were an entity that wanted to purchase or call to your ownership a commodity in the future. And you would buy a put option if you would want to sell a particular commodity in the future. Let's take a look at the financial institutions that serve as financial intermediaries. Here's the list. You have investment banks, which underwrite securities that a corporation has to put that paper into the public's hands. You have commercial banks, where you and I do our banking. And then you have a group called the financial service corporations. They consist of credit unions, leasing companies, pension funds, and insurance companies. All of these groups together essentially are entities that collect cash from other investors and turn around and invest that cash in other resources. So these entities act as conduits between investors and savers. And the fourth classification that you would have would be mutual funds. Mutual funds would be professionally managed accounts where investors would give the professional manager their cash, and the professional managers would invest in bonds and stocks at their professional discretion to make a return for the investors. In the group of mutual funds, there are different types of trading mechanisms. One would be exchange-traded funds, or ETFs, where the ETF tries to mimic a particular stock market. There are hedge funds, which are high risk in hopes of getting high return type of mutual funds. And then there are private equity funds that would be like the Bain Capital, that would directly transfer their cash to entities that want to use those funds. Types of financial institutions that you can run into. Let's put some names to these classifications. For the investment banks, J.P. Morgan, Goldman Sachs, Citigroup, and UBS would be entities that would underwrite the initial public offering of securities. Commercial banks like BB&T, United Bank, Union Bank, and Blue Ridge Bank in Virginia that maybe you bank at yourself. Financial services firms, which are known for giving their investment advice and managing retirement and savings accounts, like Edward Jones, Stern and Heatwell, and Berkshire Hathaway. Stern and Heatwell is a local Rockingham County financial services firm. Pension funds. When you get a job, you will divert a certain amount of your income to a long-term savings account. That's known as a pension fund for when you retire. Some of the large ones would be CalPERS, the California Public Employees Retirement Fund, TIAA, the Teachers Income and Annuity Association that college teachers have, the General Pension Fund from Japan, the Federal Retirement Thrift Fund in the United States would represent some of the largest pension funds on earth, and they have accumulated billions of dollars in retirement savings money. Names of some mutual funds would be Fidelity Investment, Charles Schwab, Vanguard, and BlackRock Corporation. Exchange-traded funds would go by the name of SPDRs, S&P Depository Receipts, stock exchange-traded funds. There are a group of bond-traded exchange-traded funds, as well as commodity exchange-traded funds that invest in specific types of commodities, like steel or copper or silver. You name the different commodity. There are hedge funds that try to get a high return. One is named Millennium Management, JP Morgan Asset Management, and Bridgewater Associates. Now, they're not the school that we have here, but they're out in California, and they do run billions of dollars of savings money. And then there are the private equity funds that make the direct transfer from themselves to the entities that need the cash. Kohlberg, Kravis, and Roberts, KKR, is one of the biggest. Bain Capital, you may know Bain Capital from hearing Mitt Romney run for president. He was one of the co-founders of Bain Capital. And then Fortress Capital is another big private equity fund. Now, here's your chance to answer some questions about the topics that we just covered. What distinguishes a commercial bank from an investment bank? Can you list the three major types of financial institutions and describe the primary function of each of them? And what are the important distinctions among mutual funds, exchange-traded funds, and hedge funds? And then, how are they similar? To answer this third one, some of the information that you'll need is in your text, and some of the information you can get from doing an internet search. Thank you for listening.